Have you ever wondered how businesses actually calculate the true cost of making a product? It's not just about materials or labor, there's a lot more going on behind the scenes. That's where absorption costing comes in. Absorption costing is a method used in accounting to calculate the full cost of producing a product. It includes all the costs involved in manufacturing, not just the obvious ones like raw materials and wages, but also indirect costs like factory rent, utilities, and equipment depreciation. In simple terms, absorption costing means that every product absorbs a share of all production costs. Let's break that down. When a company makes a product, there are two main types of costs. First, you have direct costs, things you can clearly link to the product. For example, the cost of wood to make a table or the wages of the worker assembling it. Then you have indirect costs, also known as overheads. These are costs that support production but aren't tied to one specific product. Things like electricity for the factory, machinery maintenance, or even the building itself. Absorption costing takes both of these and combines them into one total cost per unit. Here's a simple example. Imagine a company produces 1,000 units of a product. The direct costs, materials and labor, come to £10 per unit. On top of that, the company has £5,000 in overhead costs for the factory. Instead of ignoring those overheads, absorption costing spreads them across all units. So £5,000 divided by 1,000 units equals £5 per unit in overhead. Now, the total cost per unit becomes £15. That's the key idea. Every product carries a portion of all production costs, not just the direct ones. Now, why does this matter? Because it gives a more complete picture of profitability. If a company only looked at direct costs, it might think it's making a profit when it's actually losing money once overheads are included. Absorption costing is also required for external financial reporting in many countries. That means companies must use it when preparing official financial statements, ensuring consistency and transparency. But like everything in finance, it's not perfect. One limitation is that absorption costing can sometimes make profits look higher than they really are, especially if a company produces more goods than it sells. This is because some of the fixed costs get stored in inventory rather than being fully recognized as expenses right away. There's also another method called variable costing, which only includes direct costs and treats overheads differently. This can sometimes give a clearer picture for internal decision making. A common misunderstanding is thinking absorption costing is just about adding everything together randomly. In reality, there's a structured allocation process to ensure overheads are distributed fairly across products. So, what's the key takeaway? Absorption costing is a method that includes all production costs, both direct and indirect, into the cost of a product. It helps businesses understand the true cost of what they're making, even though it may sometimes blur short term profitability. And once you understand absorption costing, you start to see how businesses really calculate what it costs to produce and what it takes to actually make a profit.